let's start with the second session, which is behavioral finance 2.0. So, what is behavioral finance? Every one of us knows. Let me quickly do a recap and then we go forward. So, behavioral finance essentially has four pillars. The first of them is economics, the second being finance, the third being psychology, and the fourth being decision making science. Each of these is complicated topics, and each of these are independently PhD or double PhD topics. If you're going to combine them together to formulate something known as behavioral finance, it's going to be complicated. But as you've seen in the last session, we have tried to keep things as simple as possible using examples. Okay, so this session is going to be no different than that. In the last session, which we had covered heuristics like uncanny and adjustment bias, availability heuristic, regret aversion, naive diversification, mental accounting, status quo bias, gambler's fallacy, escalation of commitment, and anomalies in group behaviors like herd behavior or herd mentality and greed and fear. What are we going to do in this session? We're going to cover the heuristics like loss aversion, disappointment aversion, representative heuristics, framing bias, self-serving bias, and money illusion. Along with this, three anomalies also will be covering, which is endowment bias, reciprocity, and momentum effect. Now, with this, we would complete our two sessions of on behavioral finance. So, heuristic number one, which we're going to discuss today. Now, let's say a person invests in mutual fund schemes and he invests in large cap schemes, large cap as a category. He expects all these schemes in this category to give very, very similar returns to each other because he feels that they have a similar risk return profile. Is he right? Is he wrong? So, if I'm investing, let's say, in 5 schemes of the large cap category, will the 5 schemes give me the same return throughout the year or maybe throughout the tenure of 3, 5, or 10 years? The answer is no. Okay. CAGR, this is a slightly old data, but the CAGR for large caps for 3, 5, and 10 years, when we had plotted this, was like this. So the 3 years returns varied between plus 12.45% to minus 2.9%, where the average was 5.32%. And similarly for 5 years and 10 years. Now, assume that somebody is investing for 3 years, expecting a return of around 12.45, and he or she gets a return on a 3-year average at minus 2.92. What will happen to the financial goals? What will happen to the person's conviction in investments, right? So this is not right. That this is the fact what happens, that the returns vary so much. So what are we driving at? We are driving at a very simple point that client expects schemes in a given category to be similar on the risk return profile, which is where we enter into the new heuristic, which is known as representative heuristic. Why is it known as a representative heuristic? Is because of the simple fact that when multiple schemes in one category are there, we assume that that scheme category is a representative of the overall category, and we expect all the schemes within that category to follow this representative characteristics, which is completely wrong. It cannot be that way. Okay. So what you need to talk to the customers is this. Let's look at the mitigation for this bias. So ask the client, are you ignoring statistically relevant data in order to satisfy your need for patterns? So if this is the situation, then what do we tell the client? We tell the client in very, very simple terms that, boss, this is not going to be. At the best, a category is an indicative assumption that, okay, the returns will be like this. For example, if we talk about large caps, I will say that on an average, on a good market situation or an average market situation, the returns will be roughly 12%. If I talk about a mid cap, it will be somewhere between 14 to 15%. If I talk about a small cap, it will be somewhere between, on the higher side, it will be around 16%. But having said that, that may not be true all the time. Last year, small caps gave you a return of industry average returns of 105%. Prior to that, it was minus 35 to 45%. So it is a mere indication that large cap is there. Okay, this is the category, schemes belong to this category, understood. But when you look at the risk return profile, each scheme in that category might vary. And wherever in a particular category you have large number of schemes, there again the variation will be high. Also within certain schemes, certain categories, there are schemes which are different from each other. For example, international is just one category, but within international there are different schemes which are there. So you may need to subdivide those categories, and you may need to identify that particular company or that particular scheme here in this case, and look at what returns or what risk profile the scheme would have, not looking at overall category as such. Okay, so that is our first heuristic, which is known as representative heuristic. Coming to the second one, when I see these two lines and if I show it to your customer, what will your customer think? Which of these two lines is longer? Obviously, when we look at such lines, we see that the second line, the line which is at the bottom, appears to be longer. What is the actual case? Let's have a look. Both the lines are exactly equal. So why is the lower line appearing to be longer? Because it is represented in such a way that it should look longer. In normal language, this is known as optical illusion. In our language, that is the behavioral finance language, what is it known as? Okay, we'll come to what is it known as slightly later. We'll have an example here. So if I give your clients the following options in the health insurance floater plan. So I say there are two options: 35,440 rupees per annum as a premium, or I say 96 rupees per day. Which will your client pick up and why? Which, I'm not asking which will you pick up, I'm asking which will your client pick up. Option A or option B? So most of you say your clients will pick up the 96 one, right? Because it appears to be more attractive. Actually, which is the best option? So we understood the context of what we are trying to drive at. So both of these options are actually the same. There is no difference between the two. Next, if I give your clients two options, that I will give him or her a monthly payout of 1 lakh rupees, and he has to choose one of the options. One is he needs to create a corpus of 1.15 CR on retirement, and I will start giving monthly payouts from this. Option two, start a SIP of 3,250 per month from today and stay invested. Which will your clients pick up and choose? Most clients, again, in this case, will pick up option number two because it appears to be more attractive. Actually, both the options are the same. So what are we driving at? A client's response changes the basis, the way in which the options are framed in front of him or her. So if I frame an option in a particular way, these would be the responses. If I frame it in a different way, these would be the responses. Which takes us to the next bias, which is known as framing bias. So in normal language, this could be looked at, the first slide could be looked at as optical illusion, or in behavioral finance, we can call it as framing bias. Fair? So how do you handle this framing bias? Frame the options for the client in such a way that the response is what you're expecting. Now, this can be a very smart move. So if you remember last time when we did our heuristics and biases, most of the cases we said that if this is what gets identified as a bias, try to move the client away from it. Now what we're trying to say is no. If you see framing bias, don't interfere. Just ensure that you frame your questions, frame your statements or your options in such a way that the client chooses whatever you want to choose, whatever you want him to choose. Encourage the client to look at a larger picture and the longer goals. Investors, now this is a very, very controversial discussion which we're entering into. Now, if I say that investors were fared badly, they will tend to assume higher risks. And investors who have done well tend to play safe. Will you agree with me? I'm repeating my statement. I'm saying investors who have not done well for themselves in terms of investments, they will tend to take higher risks. Investors who have done well for themselves tend to play safe. Now, you would actually expect the reverse way, right? But no, this is true. Both these statements are true. Let me give you two examples here. Let's say there are two students in the classroom. One student, both students want to go get above 90%. Now the paper is tough, and one student is in a situation where he knows he'll get above 85 or 87, but he will not cross 90. There's the other student, student number 2, for whom the paper was absolutely bad. He knows he will get maybe 50, 60, not beyond that. Or maybe even he'll flunk. Which student will take a higher risk? For the student 2, the second student, he knows that flunking in the exam or getting 40, 50% in the exam is actually not going to help him in any way. So he might take a risk of maybe copying or maybe doing something else. But the student who's already getting 85, 87, he knows he'll fall short, but he will not want to take such a high risk that in case he gets caught while copying, he might lose an entire year. So students who have fared badly will tend to take higher risks. Students who have done well for themselves will not want to take that risk. So then 85, 87% guy will not take that risk, but that 40, 50% guy will take that risk if he was expecting 90%. If he was expecting 40%, 50%, then again he won't take the risk. Example number 2. Let's say there's a T20 match which is going on. There are 5 overs which are there, or 3 overs which are there, and the asking run rate is 15. And there are only a couple of wickets to spare. What will be the last batsman who are playing on the crease do? They will try to hit out 4, 6s, all sorts of risky shots, because they know if they play defensive, anyways, they're going to lose the match. So why not take the risk? So they and their team have not done well till now. And now they're taking a risk to take it forward to the next level. Because they know that even if they don't take the risk, they're going to fail, lose the match. If they take the risk and get out, they're going to lose the match. But if their risk pays out, then they might land up winning the match. Whereas there's another team who's chasing the same total, has just a requirement of 5 runs per over in the last 5 years. What will they do? They have ample wickets also to spare. They will play very, very safe, because they know that singles and doubles also will take them through to their goal, and that should be good enough. They don't want to take any unwarranted risks. So again here, the team which has fared badly is trying to take higher risks. The team which has done well for themselves does not want to take that risk. Fair? Sure. Great. So this was the second bias which we discussed, framing bias. Coming to heuristic number 3. Your client is offered the following options. 1, scheme A has 70% probability of 10% loss and 30% probability of a 30% profit. Scheme B has 30% probability of a 12% loss, 70% probability of a 8% profit. Which will your customer choose and why? First case, scheme A, 70% chance that there'll be a 10% loss, 30% chance that there'll be a 30% profit. Scheme B, 30% chance that there'll be a 12% loss, and 70% chances that there'll be a 8% profit. Your answers in the chat box, please. B, Rupa B, Ruparna B. Wait, let me just check. Ketki B, somebody else had answered earlier also. So we started with Navya, Smriti, Navya, Yogeshwari, Anupama, Rupa, Smriti, Rituparna, Ketki, Yogeshwari, Lovai. Fantastic. Great, guys. Excellent. Okay. Sneha, thank you. Okay. Your answer is perfect. Most clients would choose B because protecting losses or downside is more important than getting profits. So I am okay with the 8% profit as long as there's only 30% probability of loss. Okay. I don't want to look at 30% profit. I am not greedy, is what I will convince myself. Now, if you have to choose, it is not your clients, you have to choose which is the answer which you will choose, scheme A or scheme B. What is the net outcome? Net payoff, as we call it. Net payoff of both the options is the same. It is 70% into minus 10 plus 30% to 30 is the same as 30% into minus 12 plus 70% into 8. The payoff is 2%. So it is the same. Both the payoffs are the same. Obviously, I don't expect your clients to understand maths of this level, right? This is basic, but still, the point is very clearly the third point, which is mentioned in the slide. Most clients would choose schemes because protecting losses or downside is more important to them than the probability of making high returns. Now, how can you use this slide when you're making presentations to clients? Let's assume you're trying to promote a particular mutual fund scheme. And there are two schemes which are higher in terms of returns for that said period, maybe 3 years, maybe 5 years. And this scheme which you're trying to promote comes at number 3 position. How will you defend your stand? You can use this third statement to do that. So you can say, sir, yes, their returns are higher, but on the negative side, if you see, the returns are very, very high. So do you want to have, for the sake of plus 25% returns, do you want to have a minus 17% returns? Or you're okay with the plus 22% return, which my scheme is offering, where the probability of loss or the lowest negative side is only minus 5%. You can put up this case in front of the customers, right? Most of us, if we are not sitting in a behavioral finance class, would still go with the same thing. So that is what is very important. So whenever you're talking to clients and you know for sure that, boss, a scheme is not featuring the top quartile or is not at the topmost levels, you look at on the flip side also, for a span of certain years, rolling returns, etc. Look at the minimum returns which that scheme has given and present that also to the client. The client will definitely buy your point here. Because if for the client, making money is very, very important. That is very clear. But at the same time, having lower losses is also important. And that can come from compromise of slightly higher possibility of returns. That's perfectly fine with the clients. Okay. So profit is important, but avoiding losses is more important than profit. That is what we are driving at here. I hope I'm able to make my point clear. So rational clients, if I'm a rational client, who's a rational client? A client who clearly thinks only from his or her brain, nothing beyond that. Emotions don't touch investments. That is a rational client. So rational client would tend to choose payoffs, options based on net payoff. So for a rational client, both the options which we discussed in the earlier slide are absolutely the same, no emotions attached. Irrational client would tend to give more importance to avoiding losses than the probability of receiving higher returns. So I want to avoid losses. That's my first and utmost priority, right? And then I would want to look at higher returns. This is known as loss aversion. So let me make my statement again, which I made some time back. Profits are very, very important to clients, but avoiding losses is far more important than making profits. This is known as loss aversion. If you understand this, then you will be able to project several situations properly in front of clients so that the decision comes in your favor. Points to be noted in loss aversion. Clients tend to give more emphasis on avoiding losses than to acquire gains. Psychologically, the impact of possibility of loss is twice as much stronger as compared to the possibility of gain, even of equal magnitude. So if gain has X impact on a person, the loss of that same level has 2x impact on the same person. Impact of loss aversion on clients. Make clients less extremely risk averse. So whenever I look at investments, my first is कि नहीं मेरा capital protected चाहिए, मुझे loss नहीं होना चाहिए. I don't want to make losses. I want my capital protection to be in place. Prevents clients from selling non-profitable investments. So let's say I've invested in a mutual fund scheme at an NAV of 20 rupees and the NAV has gone down to 18, 17, 16, 15, whatever. I will not sell it because I don't want to encash on losses. I want to avoid losses. Though I know it's not profitable, it's not going to go till 20 again for quite some time. I'm okay with that. I'm absolutely okay with that. I don't want to sell non-profitable investments. It makes the client to rush to do profit booking also. So the tendency is known as take money and run syndrome. So what will happen is I have invested 20 rupees, it has become 24 rupees, then it became 28 rupees. I realized that there is a 8 rupees profit on 20 rupees and that's it, was end of the day's play. Let me just quickly take that money and close it. So what will happen because of that is that if there's a further upside in the NAVs, that will not get encashed with the client. So this is completely wrong on the part of the client, because on one side they're holding on to loss-making investments, non-profitable investments. They're not selling it off. On the second side, they're selling off profitable investments too early in their life or in the life of that investment, too early. Both will restrict the client's profitability. So what you should do here is you should try and avoid this. So tell the clients that what loss I understand is important, but don't focus on loss. Why should you not focus on loss? Because why did you make the investments in the first place? You made investments to avoid losses? No, right? Nobody does investments to avoid losses. People do investments to make profits. But then the phobia of having losses completely derails the person's thoughts. That is what is important. So clearly emphasize on the fact that, sir or ma'am, investments are made only to make profits. Your focus should be profits. Your focus should not be loss and should not be avoiding losses. Coming to heuristic number 4. Case study 1. Your client redeemed the MF scheme after making 30% CAGR. The NAV moves up by 10% more. What does he feel and why? Case study 2. Your client made 25% returns on an MF scheme, whereas his expectation was only 12 to 15%. He was initially very happy. Then he met a friend who made 35% profits on the same scheme. What does he feel now and why? So first case, he redeemed after making good profit. And from there, it went still up by 10%. In the second case, he made 25% profit when he was expecting only 12% profit. And he was very happy initially. But later on, he found out a friend who made 35% the same scheme. In the both the above cases, he feels disappointed. Why? Because the outcome was not as per his or her expectations. Rational clients, we know what rational clients are now, tend to evaluate the outcome basis their overall financial goals, expected returns, etc., etc. Irrational clients tend to give more importance to the outcome as a whole, and also with reference to outcomes which their peers have received. This is known as disappointment aversion. Now, is this the same as regret aversion? Sorry, loss aversion. We did regret aversion in the earlier session, but loss aversion and disappointment aversion, are they the same? Think about this. No, they are not the same. In loss aversion, there's a tendency of loss. Disappointment can be the result of loss. The disappointment can also happen in case of profits, where relatively your profits are lower. So loss aversion will happen only when losses have been there, whereas disappointment aversion will happen when losses have been there also and profits have been there also. Now, difficult for us to handle this case, because we are happy that the customer made money, but the customer is not happy, because the customer feels that, boss, I should have got more. So in the first case, he could have gained 10% more profits. Okay, so if you go back here and see, he could have gained, he made 30%, but he could have made 10% more. So that is why he was disappointed. In the second case, he made 25, but his friend made 35. So that is why he was disappointed. So disappointment, there's no answer to it. You can be disappointed even if you have the entire world at your feet. So what do you do about it? The feeling of disappointment, dissatisfaction that follows expectations with respect to outcomes. So your outcome is X and X does not happen, you feel disappointed. Okay, and that X can keep changing also, because initially you felt, okay, I want a FD meeting returns. You got that. Then you felt, I want a balance fund return, want to beat balance funds. Then large caps, then mid caps, then situation never ends. This is different from regret aversion, and this is also different from loss aversion. Loss is basically, so there are three parts. Loss aversion is basically when you have losses. Regret aversion is you're sad that you took a decision. Disappointment aversion is you've taken a decision and now you feel that I did not make as much as I should have made. Regret aversion is a feeling of regret associated with failure related to personal choices. Because I did this, this was the problem. I did this, that was the problem. So that is regret. Whereas disappointment is I did good, but then I came to know that somebody did better than me. Disappointment aversion is a feeling of disappointment associated with a failure related to the outcome itself, not with related to the personal choices. I did a good choice, but everybody else made better money than me, so I am not happy. That is disappointment. People are disappointed when they compete. So let's say in your organization, you're trying to be the number one relationship manager or number one advisor or number one whatever, then you'll feel bad, because though you have done great, somebody does better than you. Or even in case where I know somebody who was throughout first rank in her school, but was not very happy because the gap between the first and the second was decreasing. That is also a source of disappointment, right? So whenever competition is there, and competition is not bad, but competition shouldn't result into disappointment. It should result into better performance. Disappointment may arise out of positive outcomes also. So earlier, both cases which we saw clearly that yes, was in both the cases there is positive outcome. But again, positive is relative. Disappointment is relative to others. I made 20%, but she made 30%. So that will happen in organizations also. When your appraisals happen, you got an appraisal which was much better than what you expected. But somebody whom you feel is not worth it got a better appraisal than you, or a better bonus than you. Right? So disappointment may result out of anything. Mitigation to this bias is making the client aware that he or she is operating from it, and making him or her aware that it is prudent to take rational decisions than being emotional. So look at it, what was your benchmark and what did you achieve? If your achievement is better than the benchmark which you had set, you should be happy. So in investment, I always make this statement that don't compare your returns with your friends or colleagues or neighbors' returns. You don't know what risk they took. And if you decided to take that risk, you may not be able to sleep well in the night also. So don't look at what others are making. Look at what you have set as a target, as a benchmark. If you're able to cross that, that should be good enough. Coming to heuristic number 5, very, very important again. Your client has invested in 3 schemes. All are doing very well. Okay. Now you ask your client, which of the following options does he think closely reflect the success behind the factors behind this success? Which will he choose and why? So he feels, I give the options: his talent, foresight, research; stroke of good luck, unknown factors. Now tell me what your client will choose. So the answer is A. He will feel that his talent, foresight, and research were responsible for the success. Second question. Your client has chosen 2 schemes. You have invested in his money in 2 schemes. Both are giving negative returns. You ask him the following options: which does he think closely reflect the factors behind this failure? Which will he choose and why? His lack of talent, short-sightedness, lack of adequate research; stroke of bad luck, market conditions, economic factors; unknown factors. What will your client choose? B. Now this comes to us to a very, very important statement, and that statement is, according to clients, success is always credited to them. Failure is because of all the things, all the outside factors which are not within their control. So why success happened? Success happened because of the client. Why did failure happen? Failure happened because of everything around the client, excluding the client. Okay. This includes you also. So if the client's investment do not do well, he will list down 5 reasons, and one of that reason could be you also. Whereas actually speaking, you have got no role to play. You are not at all responsible for his failure. You told him to do A, he did something completely different, and because of which failure happened, he did not listen to you. But end of the day, he will blame you. So in my sessions, I always ask this question. All of us are in the mutual fund distribution business. What are we paid money for? We are in the business of receiving abuses or receiving flack, to be precise. Not abuses is not the right word, but receiving flack from the customers. The customer needs a bouncing board when things go wrong, and that is what we are. If you listen long enough to the customer, so I've seen so many cases. Let me give you this example. So we've seen so many cases where customers' portfolios have gone down drastically, huge losses in crores. Nobody was contacting the customer. People were afraid. People switched off numbers. And the customer's temper was rising. One fine day, a new recruit, a girl went to the customer, said, "Hi, hello, sir," and etc. etc. The customer started blasting. She could have walked out. She did not. She stood in the office for 1.5 hours, listening to all his complaints, all whatever he had to say, all his frustration, anger, everything was wetting out, and she was okay with it. She was just calmly listening to it. End of all that, the customer said, "Sorry, ma'am. I know it was not your fault that my portfolio went down. People who promised me the sun never came back to see what was the reality of the situation. And nobody was answering my phones. And all this anger piled up for so many months, which finally came out on you, unfortunately. So sorry for that once again. But thank you for being patient enough for listening to me." He gave her fresh business. And that relationship is active even now. Right? So understand one thing, that we are in the business where people will give us flack, people will abuse us, people will get their frustration out on us, blame us. All that will happen, because even tomorrow you lose 100 rupees from your wallet, you will feel angry. Imagine the customer losing crores of rupees. Okay, why doesn't the client appreciate advisor if the things do well? The answer is actually twofold here. The client appreciates it only in his or her mind. The client doesn't say that, right? On the face of it, the client will not appreciate it. On your face also, no. That is the way people are. But heart and heart, the client knows that yes, you were responsible for it. He would want to take the credit for it, but he knows without you, he would not have been able to do that. Right? So this is very, very important. So let's go back to our presentation. Rational clients will identify actual factors which will have contributed to success or failure. Irrational clients tend to attribute success to personal factors and failure to external factors. Success is because of personal talent, intelligence, knowledge, acumen, foresight, etc. Failure is because of bad luck, market conditions, political economic conditions, investor sentiments, global markets, etc. This is known as self-serving bias. I will always appreciate things. I'll always try and promote my own self. Impact of investors on investors about self-serving bias. Clients tend to take unwarranted risks, very, very high and unwarranted risks. That is something which is known as "I know everything" attitude. So this we have seen in COVID times also. Good for us that a lot of people had a lot of time and they did not know what to do in that time. Good for us that some people, or most of them, decided to move into the equity markets in the form of trading, intraday, etc., mutual funds, direct stocks, and so on and so forth. And third good part for us was that since the markets appreciated from those bottoms, everybody made money. The sad part was people thought they are Warren Buffett of the modern world. They are Rakesh Jhunjhunwala of the modern world. When markets go upwards, everybody makes money. There is no rocket science in that. But the problem is ignorant people get into this frame of mind, which is "I know everything" attitude. And that could be problematic for them in the long run. So market teaches everybody the lesson it wants them to, it wants to teach them. And that is what happened here also. Clients may trade too frequently, which is too regularly, which is high frequency trading, or trade too much, which is high volume trading. This is again what happened during the COVID times, and that was very bad. Clients also suffer from something which is known as "I hear what I want to hear" attitude. So if you give them an article which has 10 points, there are only 2 points supporting that statement. They will pick up those 2 points and say, "See, I was telling you, this is what I was saying." The rest 8 points, they don't see. They will not see those at all. When they hear somebody talking positively about a stock, so somebody has spoken about 15 minutes about overall outlook of the stock market, industry outlook, etc., etc. That one particular stock or that one particular segment on which he spoke or she spoke something positively, they will pick that up because that is where they are invested. And they will say, see, I have already invested. She's saying now, or he's saying now. They will attribute that brilliance to themselves. So this is something known as self-serving bias. Mitigation of self-serving bias. Make the client aware that he or she is operating out of an SSA or self-serving attribution bias. It can be both tricky as well as dangerous, but it is required. Why is it required? Make the client get into a habit of post-analysis. So for each investment, whenever he or she makes, you can do this once in 6 months, once in a year, or once in a quarter, depending upon your relationship and the time you're allocating to that client. Do this post-analysis, irrespective of the fact whether that investment has done profits or losses. Asking certain questions would definitely help. Those questions are like this. Why did you make money? Where did you make money and why? Where did you lose money and why? What were the external factors which went in your favor or against you? Was there a stroke of good luck? What qualities you exhibited when in your favor which did not? Which of your decisions contributed to your success/failure? I will do X things in the future and avoid Y things in the future. Document this. Okay? And document however you want to document, in a notepad, or you want to document in a format, or you want to document on a mail, whatever you want to do. Because this will be a learning for investments to come forward. The answers to these basically. Coming to heuristic number 6, case study. So your client is evaluating mutual fund performance for 2016-17, 17-18. 16-17 returns were 10%, where the inflation was 6%. 17-18 annual returns dropped to 8%, where the inflation was 4%. Which of the following options does he feel is true and why? A, scheme gave better returns in 2016-17 as compared to 17-18. B, the scheme gave better returns in 2017 as compared to 16-17. And C, the returns have remained unchanged in both the years. What is the actual answer? Some clients will go with A. Okay. Why? They're only comparing nominal returns, that is 10% and 8% in this case. So if you see here in the option A clearly, 10% returns versus 10% return versus 8% return. So I'm looking at the returns itself, right? That is known as nominal return in the TVM language, time value of money language. This is known as nominal return. But as an investor, am I concerned with nominal returns? The answer is no. I'm concerned with something known as real rate of returns. So I'll give you what context I'm coming from here. So everybody, when I say equity returns in the Indian stock market, people ask me, what is it? I say it is 15%. 15 and a half to be precise right now. People say, okay, when you're looking at 30 years hence, or when you're doing retirement planning for somebody, do you feel that after 10 years, after 20 years, we will still get this 15% return? My answer is no. Because 15 years, 16 years back when I started tracking this, I found out that the returns were 18%. Gradually, every 5 years, the returns are dipping by roughly 1%. So, is it right that I can assume 15% going forward? Maybe no. But should it actually concern me? My answer is no. It does not bother me whether the returns are 15% or 7%. People say, why? I say you should not be concerned with the returns. You should be concerned with the real rate of returns. Real rate of returns in simple language would be returns minus inflation. So let's say right now my returns are 15%. Inflation is 7.5%. So my real rate of returns is around 7 to 8%. I should be concerned with that only. Tomorrow, let's say the returns come down to maybe 10% or 9%. Should I be bothered? No, I should not be bothered. If my inflation is between 1 to 2%, then I'm not bothered, because still my net real rate of returns is this much only. So don't worry about that. What you should look at is more of the real rate of returns as compared to the nominal rate of returns. That is the crux. So if you're able to explain this concept to the clients, then the clients will also understand that, okay, 10 years hence, I don't know, or 15 years hence, I don't know what will be the returns equity market will give on a year-on-year basis. But at the same time, I don't know what inflation will also be there. If my best case assumption is that inflation over, so real rate of returns over inflation will be roughly around 7-8%, then I should be sorted, right? That is important. So I have some answers here. Same with this. Yes, thank you. So why? Because they are comparing the nominal returns, which is 10 and 8%. So I'd given you the case that I want you to answer basis what your clients would answer, and you have all given the right answer. So this is exactly what the clients will answer, because they believe nominal returns is equivalent to purchasing price. The fact is that real rate of returns is equivalent to purchasing price, not the nominal rate of returns. The scheme returns have remained the same for both the years because the real rate of returns is 4% in both the years, right? So that is the spread which you want to look at, your returns minus your inflation. So rational clients will identify and think in terms of real returns. Irrational clients will be more weighted towards nominal returns. This is known as money illusion. Illusion is like a myth. Illusion is like something which you don't see. So something which you are made to see, which does not exist. Typically, your mathematicians, your magicians, and your illusionists are the people who create this, right? In money, also illusion happens. So though you will see let's say you tomorrow get a 20% return, but your inflation is 14%. Is that good? No, it's not good. Because net your real rate of returns is 6% there, which is lower than what it is today. So though your returns would move from 15 to 20, still your inflation is also moving at a much faster pace, and that's not good. Framing bias is purposefully what we do. So framing bias is I frame the statements in such a way that I want people to choose a particular option which I want them to choose. People will choose a particular option which I want them to choose. That is framing. This is not framing. This is exactly the way in which normally people perceive things. Money illusion is what people normally see. So I need to educate my clients and get them out of this. So when they ask me whether I will get 15% returns, I say no, and I say add to it that it shouldn't bother you as long as your spread over your nominal and inflation is the same. Similarly, then I ask them that tomorrow, let's say India as an economy degrades further and you get a 20% return on your investments. Should you be happy? Maybe no. If your inflation is at 14%, you should not be happy. So then they understand that what they are looking at is not the right number. They should be looking at a different number. Okay. So framing is what I purposefully do with my clients. Money illusion is from where I have to get my clients out and make them see the real picture. Okay. So mitigation, making the client aware that he or she is operating out of a money illusion bias is good enough. Educate the client with respect to nominal returns and real returns. Encourage the clients to look at only real returns when two schemes are compared or when one scheme is compared over two different time periods. And identify money illusion bias and making the client aware of it can be a good strategy for moving money from low RRR investments into high RRR investments. So when we talk about moving money from fixed deposits to equities, to mutual funds, what is our baseline statement? Our baseline statement is very, very simple. Boss, your FD will give you 7-8%. That also nowadays you don't get. And from that, if you remove inflation and taxation, nothing is left. Whereas the same you move into the equity markets, okay, today returns are not great, but still on a longer horizon, you'll get good returns and you should be sorted. So moving money from a low RRR investment, which is your typical FDs, RDs, post office products, etc., to high RRR investment, which is your equity, your mutual funds, equity, etc. Coming to certain anomalies in behaviors, group behaviors, three only we are going to do today. So anomaly number one, I'm not reading everything. So what happens is when somebody owns something for a longer period of time, there's an endowment effect associated with it. Okay, there's something known as endowment premium. So let me explain this. Let's say a person had bought a stock or a particular thing. So even stocks for that matter, and they want to sell it. Now let's say I have a car, okay, and it was my first car and I've been having it for the last 10 years, etc., etc., very close to my heart. Now there's X price associated within the market, but I am not looking at X, I am looking at Y. What is the reason? The reason is because I am adding a certain premium to it, which is known as endowment premium. That is exactly Y minus X. So I'm demanding slightly more price because I have been owning it for a longer time. It's very close to my heart and it is my first car, emotions attached, etc., etc. But for that is all for me. For the person who's going to purchase from me, these things don't matter to him or her. So whenever you see that particular thing is not getting sold, try and check whether the person trying to sell it is selling it at the same market price or not. If no, there's a spread which is there, then understand that spread is your endowment premium. You need to convince the client to remove that and then everything will get sorted. Also, endowment effect leads to holding on to certain stocks which the person has bought very initially. This is junk which he's holding on for quite some time. Even if it may not be junk, it may be premium companies also. Maybe right now, disposing of all that and reinvesting the money is a better investment decision. So for that, you have to ensure that this endowment effect is taken care of. Next in our discussion, now here if we see that when you do some friendly action to somebody, people tend to be much nicer, much friendlier, much approachable to you. In case you do something hostile, people are more nasty, more brutal, more aggressive towards you. On both sides, people extreme. So if they shower their love on you, that is extreme. If they are nasty with you, that is also extreme. People categorize actions as kind by viewing both the consequences and the intention of the person. This is very, very critical. Understanding the difference between these two terms, consequences and intention. So I did something to you, intentionally bad. You'll understand it. I did something to you with a good intention, but the result turned out to be bad. Okay. Then what is the situation? My reaction will be different. So you were walking, I put a leg across and you tripped. I intentionally tripped you, you will be angry with me. I tried to help you on a slippery floor, and by doing that, I actually landed up you for having a more nastier fall. But you will not be angry there because my intention was to help you. The consequence turned out to be different. That was not within our control. People believing trading favors with other people. Now, all of us have been brought up in a situation where you go back to your homes and go back to your childhood, when a neighboring auntie gave something sweet or something which she had prepared at home in a container, in a vessel. Did your mom return that vessel empty? Never. So she would probably keep the vessel for a day, maybe 2 days also at times, but return it with something which she has made or she has brought from outside. Never return an empty vessel. This is what we have been taught right from childhood by demonstration, not by talk. It's by demonstration. So it is ingrained in our system. We will always trade favors with other people. So this is what we've been taught right from childhood. This is known as reciprocity. You reciprocate for a positive action, you reciprocate in a positive manner. For a negative action, you reciprocate in a negative manner. Now, how does this work out in our business? You do a favor going out of the way for a client. The client will return a favor. He will not go out of the way because there's no option available for him, but he'll eventually return that favor by giving you business. So kinder action never goes unwarranted, never goes waste. So I'm not saying just keep doing favors to people, and all favors are do not need money. You have some contacts somewhere, you can help some people out. You have some information, you can share that information with somebody. Somebody needs certain issue to be sorted out. You can give that sort that issue out with that person, help him out in that, etc., etc. The return will be positive, mostly in business. This is known as reciprocity. So you can use it for your own benefit. Okay. The last point of our discussion. Now, for those who have studied finance or have done your MBA, there is something known as EMH. EMH is nothing but efficient market hypothesis. In short, it's a big theory. In short, it says that markets are efficient. Efficient in the sense that they factor in everything and prices are a reflection of that efficiency. So one statement of EMH is price changes should happen only because of changes in demand and supply or the presence of new information, nothing else. But we have seen that rising prices continue to rise while falling prices continue to fall. Does this go in line with the EMH? Absolutely no. The increase or decrease of a stock price in itself should not warrant a further increase or decrease. This anomaly is known as momentum effect. Now we have seen that because the price was high yesterday, it is high today. And because it is high today, it will continue to be high tomorrow. Wherein the fundamentals were the same, no difference. This is momentum. Take a stone, take a metal ball, and try to roll it on a floor. Initially, it will be difficult, but once it starts rolling, it continues to roll. Rather, it will pick up speed also. It is known as momentum in physics. So rising prices will continue to rise. Falling prices will continue to fall. If that is because of fundamental changes, that's a different discussion. But without fundamental changes, it can still happen, and that is known as momentum. So technically, is momentum driven by fundamental prices? No. If anything is not driven by fundamental prices, what will happen to it? It will cease to exist or continue after some time. So if the rising prices are because of momentum effect and not fundamental changes, what will happen? They will stop rising after some time and maybe turn back also. That will result in big losses to your customers. So what you should do is tell the customers that, boss, there is no fundamental change. The price is just rising because it is rising. It will eventually stop, and it will not stop there. It will go back. Means you'll have a loss if you've invested in this kind of a situation, right? Also tell the clients that investors normally underreact to new information and fail to incorporate it in their transaction prices, because what they see is the upward movement in prices. What they hear is about information which says this should not happen, but this continues to happen. and therefore they do not give any significance to that information which they are receiving, and they follow only the price movements, and that is where they get into losses. So whenever you see momentum effect, shake that person and tell them that, boss, no fundamental support, only technical, only momentum, remove it, you are heading for losses.